Michelle Boyce, Vice President, Rosenzweig Financial Services, and I am going to be your presenter for this evening. So last year we did monthly webinars. This year we're going to break it up and do quarterly webinars. And the first topic that we're going to do on the first quarter here is the accumulation phase of your financial life. So just a quick housekeeping items. This is being recorded, like I mentioned. There is a chat feature as well as a Q&A feature in the toolbar. So if you have any questions throughout, I will check the chat and try to answer them either at that particular time, but if not, definitely at the end of the session. All right, so our quick disclosure for compliance. So basically, I'm not giving any legal advice tonight or tax advice. So the team at RFS, most of us probably know on the call, know all of us, Mickey, Stewart, and myself. Tonight, I'm going to be tackling the accumulation webinar, but they're going to join us in the future on the distribution and legacy webinars. All right, so why did we pick the topic for the different financial phases of your journey, of your financial life for this year as our webinar series? And the reason is because depending on the phase of life that you're in, you really are having different needs and should be planning different ways. Okay, so when we think of someone's financial life, almost envision it here as this mountain, right? And most people think of, their goal is that they want to accumulate their wealth, get to the top of the mountain. And that's what we're going to talk about tonight, right? That's till retirement, right? Or till you start to slow down. Then you enter a second phase of your financial life, which is called your distribution phase, where now you're no longer worried about necessarily growing your wealth. It's more of how are you going to spend your wealth in retirement, because you're no longer bringing in a paycheck, your assets need to support your lifestyle. And at the end of the distribution phase, right, there's that legacy, because ultimately, at some point, we're no longer going to be walking this earth. And then whatever assets that you have left from $10 to $10 million are going to go somewhere. And that's going to be what we focus on, the legacy portion. So each of our quarterly webinars, tonight's accumulation, next quarterly is going to be distribution, and then finally we're going to have legacy. All right, so what are some goals when you're in the accumulation phase of your financial journey? And it's really kind of simple, right? The first is you want to be saving money. Back to that mountain analogy, you need to be climbing the mountain so that when you get to retirement, you have enough money to be able to retire. Along the way, you're going to want to achieve some goals, right? From buying your first home, to educating your children, to taking your annual vacation. Next week's spring break, so that's on my mind here, right? Of that vacation. And then obviously you want to grow your wealth. You want to get a return on that savings so that it's not just you putting to work, but then also your money is at work. So your financial life is really broken into 4 components. And this is a concept that I heard recently from a professor at the American College that I thought was really interesting, which is why I wanted to share it. You've got your human capital, right? So if you think about your wealth, the first is your human capital. And that's really your earnings potential, right? That's you going to work every day. Then we have pension wealth, and this is in no particular order, right? So pension wealth are things like guaranteed incomes. So right now that's Social Security payments. This really comes into play in the distribution phase. Guaranteed income from different annuity products, okay? So that's one type of wealth. The third type of wealth is financial wealth. So those are those liquid assets that you're saving and that you're building. And then lastly, we have our housing wealth, right? Because we have our wealth that's tied up into our real estate, right? That isn't liquid for you, right? You're not going to pull a piece of brick or siding off of your home and go over to the grocery store, but it is significant wealth, especially if you live in Florida or New York or California, right? It's going to be a huge asset. So your wealth is really broken into those 4 different areas. So as we start to build someone's financial life, there's really a phase to do this. There's different order. And we're going to talk through this tonight. So if I was meeting you from day one and you were starting to build out your financial plan and you had your first dollar of wealth, the first thing we want to do is making sure that you have a strong and full replacement value. Okay, and I'll talk to you exactly what that means. On top of that, we want to make sure that you're saving at least 15% of your income into your financial model. And we'll talk about why that's important and why that 15% is kind of your minimum amount. Then we're going to talk about liquidity, right? You need to be building liquidity and why you should be building liquidity. And lastly, talking about how you save and how you should be diversifying your savings, right? And as one of the things is contributing, example is contributing up to the match in your retirement plans. So let's just first start with the protection, right? That foundation, right? If you're building a house, right? The first thing you're going to do is dig into the ground. You're going to build a strong foundation so that you can build your house up. Okay? Same thing applies in your financial plan. You want to have a strong protection or a strong defense against things that can erode your wealth. And the three that we're going to talk about tonight are lawsuits, right? In case you get sued, disability, if you become disabled and can no longer work, or premature death, right? Now, premature death is kind of an odd statement because all of us, death is premature at any point, but we want to make sure that what this really means is during your peak earnings potential. So back to this. So right now, when you're in the accumulation phase, for most of your life, that is your largest asset, okay? You have very little pension wealth. Let's take an example of someone in their 40s, right? They're not tapping into Social Security or any guaranteed income, right? So that's a small factor. Their financial wealth is probably much smaller as well because maybe they're just getting started of feeding their financial plan. And maybe their housing wealth is the second biggest component, because they bought their first house. Okay. So when you were younger, you're in your 30s and 40s, your human capital is your largest asset. As you get closer to the top of that mountain, your human capital gets smaller because those other components get larger. Okay. And that's ultimately the goal. That's what we're trying to achieve. So how does this pertain into what we're talking about with protection? Okay. So just like your human capital, right? Your income and your ability to earn that income is your greatest asset. Okay, looking at this example, if you have a 40-year-old who's making $250,000 a year, right? If they're going to work till 65, which isn't even traditional retirement these days, but it's easier calculation than 27 years, right? They're going to bring home $6.2 million into their household. Okay, guaranteed that they're not sitting on a $6.2 million asset of a 401k or a house or even a combination. Very likely they're not. Okay. And then when we add on a cost of living, because most people are getting a cost of living adjustment. So if that's 3%, that's over $9 million, right? That's why that human capital box is so big, because that's what you are worth. The reality is we're all walking around with dollar signs as our value, okay? That's the income we're bringing into our family and our household over our lives. We want to make sure that we are protecting that against anything that could take it away, shorten it, or not let you hit your max potential. So what's one of those things that could take it away? Okay, lawsuits. So I'm down here, Mickey and I live in South Florida, right? And there's an attorney on every corner. And one of the things that we see with lawsuits are car accidents. And if you've ever driven on 95 through South Florida, you know why, right? So let's talk about how car insurance works. And most advisors aren't talking about this, but really it's important, okay? Inside your policy, you have what's called limits of liability. It's either 100, 300, or 250, 500, or something like that. And what that means is, let's in this example, 250, that is your lawsuit, what we call your limits of liability or your lawsuit protection for you if you are in an accident. The 500 is if there's more than one person in the car, they're going to pay up to a maximum of 500. Okay. If let's take that same example in that last slide of that 40-year-old who was going to bring home $6 million, and they're in a car accident and they become disabled, you just took away $6 million of their potential wealth because now they can't work. You think they're going to be happy with getting a payout of $500,000, right? Likely not. Okay. So they're going to sue you for their lost opportunity, right? For their income. So, what's a very simple solution that almost everyone should have? And that's a umbrella policy, right? And it's umbrellas come in lots of $1 million and act as an umbrella on top of your car and home. So now if you're in that same accident, you have $1.25 million of coverage or 1.5 million. Or if you've got a $3 million umbrella, you've got 3.25. Okay. That's a much more likely amount to be able to be paid out from the insurance and not have to come and confiscate from your assets. Okay. So one way we want to make sure we're protecting is making sure you have umbrella. Okay. The second thing that can erode your wealth is disability, right? Back to that prior example. Because what does your income do, right? Besides feed your financial plan, it does all these other things, right? Your income is what allows you to pay your mortgage. It allows you to travel with your family, put food on the table, save. Okay? Without your income, you really cannot live. Right? So your income is that foundation of everything we want to accomplish. We want to make sure we're protecting your income with disability insurance. Most people get disability insurance through their employer, which is great, but it's typically capped at 60% and $10,000 a month, and it's taxable. Okay, so if you are getting that $10,000 a month benefit, but you're in the 40% tax bracket, okay, well, now you're going down to $6,000 a month. So you should be really looking at having enough disability to stack on top to be able to get you to your full maximum potential, which is usually 60 to 66% of your income is what you can be insured for. And when you own individual disability insurance, it does all of these things, right? It allows you to be insured first for your own occupation, what you do on a daily basis, not what someone else does, which is very important, especially if you are in a specialized craft. Okay? It also locks in that premium. So no matter what happens if you get individual disability and then later in the future become disabled, right? Or you have a health condition that wouldn't allow you to get new coverage, they cannot raise those premiums. They are guaranteed. Okay, so having disability is that second key foundation of making sure that you're protecting anything that could erode your wealth. The third area in the protection that we're going to talk about is life insurance, right? Because that was the third. We had lawsuits, disability, and death. And there's really two conversations when it comes to life insurance. It's the amount and it's the type, right? And the reality is the amount is what is most important, especially in your accumulation years and if you have a family, right? You need the amount that's going to protect your family and replace your income if something happens to you. Right. So again, back to that example of that 40-year-old who's going to bring home $6 million. Right? They should have several $1,000,000 of life insurance that then can be invested and spit off that same income so that the family can keep the same lifestyle. Okay. The second part of it is what is the conversation of what type? Do we want permanent or do we want term? The next slide kind of gives you a few highlights of the different types. So term insurance is more of a short-term need, right? Because it comes in lots of time from 10, 15, 20, 30 years, okay? So you have a shorter term need for coverage, or potentially you have a cash flow issue currently, but you need the coverage. So you want to make sure that you're getting enough coverage through the term insurance. But it's kind of like renting, right? You're not building any equity, but it is providing a roof over your head. The other thing that term insurance does, it locks in your insurability. Just like I mentioned on disability, you now, if you, let's say you get preferred plus, which is the best health rating. So it means your internal costs are less. And then in 5 years down the road, you get some sort of disease and you're no longer insurable or you're insurable at a much lower health rating. Because you have the term insurance locked in, that premium can't change And you could actually convert to permanent coverage without what we call evidence of insurability, right? So you can convert from term to permanent. That's the term side, right? So now on the permanent side, permanent comes in all different shapes and sizes, right? And it does really two things. The first is that it can provide death benefit protection forever, right? So if you're looking for a long-term solution, something that's going to be in place for when you pass, which likely will be later in life, permanent insurance is going to be a better fit. There's also different types of permanent that builds cash value, right? And that cash value can be used so that you don't have to pay the premium in the future. It can be used for tax-free income streams in the future. It can be really used for anything that you want it to be. It's an asset on your balance sheet, okay? So when you're deciding and having the conversation about life insurance, right, we always start with what's the appropriate amount to protect you and your family if something was happen. And then we talk about what's the appropriate type, right? And oftentimes it can be a mix of both, right? You've got some permanent today and you've got some term. I've had the unfortune that throughout my career to have to process a lot of death claims, especially earlier in my career. And the one thing that I realized is that the surviving spouse never asked what type of coverage it was. It was always what's the amount, right? Which really has instilled in me why having the appropriate amount is what is so important. So that wraps up protection, right? So building a strong foundation and having that full replacement value. Now we're going to talk about your savings, right? The second rule is that you should be saving 15% of your income into your financial plan. And why is that? Okay. The first thing is, well, you need to give it some gas. Okay. If you're in a car and you're here in Florida and you want to drive to New York, if you only fill your tank up one time, I guarantee you, you're not going to make it, right? Even if you're an electric car, you're going to have to stop and charge up, right? Because you have to keep feeding it to get where you want to go. Why is 15% the rule of thumb? Well, it's because as we save, there's eroding factors that happen in our life. And I have some of these listed there, right? So saving that 15% really is what's helping you kind of offset some of those eroding factors from inflation, which we all have been feeling for quite some time, taxes, the ups and downs of the market. We talked about lawsuits already. So at a minimum rule of thumb, you should be saving 15%. Now, when we meet people, they're saving all different levels, right? Some are saving much less than 15, some are saving much more. The goal is that over time, we can get you to that 15% mark or more. This is an example that talks about the rule of 72, right? Which is another driving force of why you should be saving, right? And why you want to start saving when you're younger, right? Because you want time on your side, not time not on your side, right? Because there is an economic factor out there called the rule of 72, which basically is how long till your money doubles, right? Depending on what rate of return it is, your money is going to double over a period of time. So if we're looking at the chart on the right, let's use that 7% return. Okay, so if your investments earn 7% each year, in a little over 10 years, they're going to double in time. And I'm sorry, double in value, right? So if you have $100,000 today, they're going to be $200,000 without adding anything to them. Okay? The other example is showing someone who's saving it, but saving on a different time period. So we've got Megan to start, who's saving $100 a month, and she begins at 25 and does it for 10 years. So she only invested $12,000 over that period of time. But by the time she gets to retirement, that $12,000 has turned into over $200,000. Then we've got her counterpart, Joe, who saved the same $12,000, but he started 10 years later. So his money didn't get to compound as long, and it only grew to 150. Okay, so that's the rule of 72. You want to use time as your benefit when you're younger. So we talked about full replacement value, savings. Now let's talk about liquidity, right? And the saying is cash is king. And the reality that never goes out of fashion, especially in today's world where your cash can earn 3 to 4%. Rule of thumb is that you should have 6 months of your expenses or your income in safe, liquid locations. Okay, that does not mean invested because you want to be able to get your hands on those dollars quickly, no matter what the circumstances are. And why? Why do you need to get your hands on money quickly? Well, the first, it keeps you out of debt when emergencies happen. Okay. So, two examples of myself, right, that are just happened in the last 24 hours. Mickey Stewart and myself, we were all in Philadelphia for 2 days. I flew home last night, got to the airport. My car wouldn't start, realized my battery was dead. So I had to get my car jumped, and now I need a new battery. I have a hybrid to find out that that battery is over $1,000. I wasn't prepared when I landed that I was going to have to spend an extra $1,000 that day to get a new battery. Okay, that happens. To make it worse, I come home and our air conditioner is out and it needs a new coil along with some other things, which is another couple $1,000. So in 24 hours, I had a $3,000 emergency. Right? This is why we need cash, because life happens and we need to be prepared. Because the worst thing that I'd want to do is they'll put that on a credit card and pay 24, 32% interest for that emergency. Okay, so that's the bad side, right? Another example is if you did become disabled, right? Most long-term disability doesn't kick in for a period of time. So you need to be able to cover your bills. But a positive reason why you need cash on your side is what if you have an opportunity? What if an investment opportunity comes your way in real estate or in the market or in your friend's company that they need a startup that's going to be a huge success? If you don't have that money liquid, you're going to miss out on those opportunities. So when you're saving that 15%, we want to make sure first that that savings going in to build you 6 months of liquidity. So again, protection, savings, liquidity. Now let's talk about diversifying that savings, right? Because not all savings are created equal. If you saw my RFS resource minute for February, I talked about the tax triangle. We're going to talk about that again tonight, right? And I said it can be as dangerous as the Bermuda Triangle. Your money is taxed one of three ways, right? It's either going to be tax-free, it's either going to be taxable, or it's either going to be tax deferred. And we want to have balance between all three areas. Another way to say this is rather than a triangle, let's say you have 3 buckets of wealth, right? And the taxation is different on each of those buckets. We want to make sure that one bucket isn't overflowing where there's hardly anything in the other 2. We want to have balance, right? Why do we want to have balance? Because there's advantages and disadvantages to each of those different types. So first, let's talk about taxable. So taxable, when your taxable savings is usually liquid to you. Okay, these are things, the simplest example is your money market, right? So let's say you have $100,000 in your money market, and right now it's earning 4%. So that year you earned 4,000 of interest. That is taxable to you. You are going to pay taxes on that each year, but you're going to pay that usually at capital gains rates. Okay, this applies to also your investment accounts. Okay, depending on how long you hold it and when you sell, most of that should also be capital gains tax, right? So you've got the positive of being liquidity, you've got the ability to pay capital gains versus ordinary income tax. Okay. Then we have tax deferred. So those are things like your 401ks and your IRAs, where you're not paying any taxes on that today. You are deferring that for the future. And I want to make sure that we're clear that it is a deferral, not a deduction, right? Because a deduction is something that you deduct and you don't pay the tax on. A 401k is a deferral. You don't pay the tax today, but you do pay when you take the money out in retirement, and you pay that at ordinary income rates. All right, so some of the advantages are that you don't pay it today, right? It can be automatic, but some of the disadvantages is that you don't know what that tax rate is going to be when you're in retirement. You could have been deferring this whole time at 30%, So you're saving 30 cents on every dollar to get to retirement and potentially take out at 40 cents. Okay. And there's also these things called required minimum distributions, or RMDs, where they kick in and the IRS says, well, now you have to take a certain amount out. And that currently starts at age 75 for most people in their accumulation phase. It's also not as liquid, right? There's 59 and a half rules where you have to be over 59 and a half, or they charge you a 10% penalty in most examples. And then we have tax-free. These are things like your Roth 401k, your Roth IRA, or cash value life insurance, where you pay the tax today, but then all of the growth is it grows basically tax deferred, and then you can access it tax-free. Right? So the advantage of that is that you've paid the tax, you can access it tax-free in the future. It's not always as liquid as taxable though, right? So each of those different areas have different advantages and different disadvantages. So we want to make sure that you have balance back in that triangle so that you can take advantage of each of those. I work with a lot of individuals getting ready to the distribution phase of their life, so going down the mountain, and most of their wealth has been accumulated and tax deferred because they've saved a lot into their 401ks, they had good growth in the market, and now they're very lopsided at retirement, and they're going to pay a lot in taxes because they have to take so much in RMDs. So just like everything, you want to have balance so that you're able to take advantage of all of the good and kind of eliminate some of the bad. Right? So like I said, they each have different advantages and disadvantages, from tax rate risk to market risk to inflation risk. So this concept is called asset location. And you've all heard of asset allocation, right? You've got in your investment account, you've got some large cap, you've got some small cap, you've got international, you've got bonds. Oh, sorry about that. That is asset allocation. And we do that because in theory, when one sector is winning, another sector might not be as well, but vice versa, that will change at some point in the future. So it's able to take some of the peaks and valleys out of your returns and make a smoother ride. Same concept here with asset location. Just like you diversify there, we want to diversify within your taxation. So the key takeaways of tonight from our accumulation phase is that there are definitely proven steps of how to build a financial plan, right? That's what we covered each time, from building your foundation. What does your protection component look like? Get that to your full replacement value. To saving, putting money into your financial plan at that minimum of 15%. To building that liquidity, having cash is king so that in an emergency, you can get your hands quickly on dollars. Then to savings, to make sure that we're diversifying our savings and not saving all into, the most example is your retirement plans. We want to make sure we have diversification. Another key point is that while you're in your accumulation phase, the ability to earn an income is your largest asset, right? Unless you're sitting on $9-10 million, right, of assets, that's likely what you're going to bring in as an income. So you need to protect it against anything that could interrupt it, or take it away. Okay? And to achieve your goals, to get to the top of the mountain, you have to save. Okay? And then when you do with that savings, diversify it so that you have as many options as possible when you get to retirement, and you're not pigeonholed to have to take your wealth one particular way. So that is all that we have for this evening. So if you have any questions, please put them into the chat and I would be happy to answer them. So one question that kind of popped in here is, how do you know when your accumulation phase is ending, and like things that you built during that now you should move to your distribution phase? Okay, let me try to answer that as clearly as possible, right? So remember the human capital box, right? And that human capital box is very large in the earlier you are in your accumulation phase. That shrinks over time. because now you've accumulated more of your housing assets, your pension assets, and your financial assets. So as those grow and you're getting to that top of the mountain and we're starting to consider what distribution planning is, that's when some of those other protection items become not as important, right? Because now you're going to rely more on the financial side or the pension asset. So distribution planning and accumulation planning are very different, but it's also one continuous path. Okay, because as we just discussed, the way that you save today is going to have a significant impact on how you're going to get back down the mountain. Right. So if we meet when you're in your distribution phase, we're going to do the best that we can to get you the smoothest ride down with paying the least amount in taxes. But if we meet during your accumulation phase, I absolutely know we can do strategies today that are going to give you that smooth ride back down to meet your goals. All right, so I thank everybody for attending this evening. So as I said, we are going to be doing this quarterly now. So our next webinar is going to be in June, and that is going to be on the distribution of your financial plan. So if you have any questions after this, you can always reach out to us, send us an email, give us a call. Hope you have a great evening.